Welcome to The Explainer. Today we're digging into a fascinating case study on exactly how to handle sudden, massive national wealth. We're going to look at how Chile took a very lucky commodity boom and instead of just squandering it, engineered it into a permanent economic shield. It's an incredibly smart approach to fiscal discipline and honestly a masterclass in financial architecture. Here's our roadmap for today. First, managing the copper boom. Second, Chile's sovereign wealth funds. Then we'll look at the strict rules and transparency, followed by the pension fund ecosystem, and finally, why this all serves as a model for resilience. Let's jump right in. Part 1. Managing the copper boom, a trillion-dollar dilemma. I want you to imagine a sudden lottery win for a second. You're running a country, right? And your main export is copper. Suddenly, between 2003 and 2007, the price of copper just absolutely skyrockets. We're talking a jump from around 80 cents a pound to almost $4 a pound. Your government coffers are literally brimming with cash. Now, history is full of countries that struck gold, or copper in this case, and just spent it all on immediate gratification, which usually triggers massive inflation and instability down the line. So, what do you actually do? Well, looking at the global context back around the turn of the millennium, countries all over the world started hoarding massive assets from their own commodity windfalls. But just throwing money into a giant pot, that isn't enough. It's how you structure that pot that really matters. And that perfectly sets the stage for Chile's unique, hyper-disciplined approach. Part 2. Chile's sovereign wealth funds. The two-fund solution. Before we get into Chile's exact model, let's just do a super quick recap on the core concept. A sovereign wealth fund is essentially a special-purpose investment portfolio owned by the government. They take their excess cash, usually from natural resources, and buy foreign assets. They do this for two main reasons, either to stabilize the economy when times get tough, or to save up for future generations so the wealth actually outlasts the resource itself. Now, what's so brilliant here is how Chile split these responsibilities. In 2006, under a new fiscal responsibility law, they created two completely distinct funds. First, you've got the Economic and Social Stabilization Fund, or the ESSF. Think of this as the ultimate rainy day fund. Its whole job is to cover fiscal deficits or pay back public debt when the economy takes a hit. Second, we have the Pension Reserve Fund, the PRF. This one is the lockbox. It's designed to finance future government pension obligations, basically making sure they can take care of their aging population long after the copper boom ends. To give you a sense of the sheer scale we're talking about, in 2007, the Chilean government seeded that stabilization fund, the ESSF, with a massive initial deposit of $6 billion. The pension fund started with about $600 million. But here's the thing. Having billions of dollars just sitting around creates a pretty massive temptation for politicians, doesn't it? Part 3. Strict rules and transparency, good governance in action. So how do you actually protect those billions from political mismanagement, short-term spending sprees, or even outright corruption? Chile's answer was to build an absolute fortress of rules. First, they delegated the day-to-day management directly to the Central Bank of Chile. Why? Because the central bank already had a stellar, established reputation for managing international reserves. Second, they set up an independent, specialized financial committee just to advise on investment policy. And third, they strictly adhered to the Santiago Principles, which is basically the global gold standard for sovereign wealth fund transparency. And these weren't just empty promises on paper either. Chile's rigid standards were actually put to the test. In 2008, the Peterson Institute evaluated 34 countries with sovereign wealth funds, and Chile earned an incredible 8th place for transparency and best practices. They essentially proved that a developing economy could outgovern some of the richest nations on Earth when it came to fiscal discipline. No small feat. And that discipline is built directly into their investment strategy. They are incredibly precise. The Pension Reserve Fund isn't just out there trying to make a quick buck. Its specific mandate is to achieve an annualized return of at least 2% over Chilean inflation across a 10-year horizon. Plus, they strictly cap their risk. The probability of losing more than 12% in real terms in any given year absolutely must stay under 5%. It's calculated, it's careful, and it's totally transparent. Part 4. The pension fund ecosystem, Chile's secret weapon. But, the government funds are really just one piece of a much larger puzzle. The real secret weapon of Chile's economic stability actually lies in the private sector. In Chile, everyday citizens contribute to private pension funds, known as AFPs. And because the domestic market just isn't big enough to hold all those retirement savings, these private funds invest heavily abroad. By 2007, these private pension funds had amassed net foreign assets equal to a staggering 26% of Chile's entire GDP. That is incredibly rare for an emerging market, and it created a totally unique financial ecosystem. Let's just walk through the logical flow of how this machine actually operates. Step 1. The central bank manages the traditional foreign currency risk using its reserves. Step 2. Those massive private pension funds invest overseas, but by law, they have to protect retiree savings from a wildly fluctuating peso. They do this by buying financial contracts to lock in the value of the currency. And steps 3, by consistently needing those contracts, the pension funds naturally become the counterparties for domestic banks and corporations who need to hedge their own risks. So because of exchange rate risk, which is just the danger that a dropping local currency makes foreign debts way more expensive to pay back, the pension funds are constantly in the market hedging their assets. This creates a highly liquid, deep derivatives market. Essentially, they're selling exchange rate insurance to the rest of the Chilean economy. They absorb the risk so the government and the central bank don't have to step in and do it themselves. It's practically genius. Part 5. A model for resilience, the macroeconomic impact. Let's look at the real-world impact of this beautifully integrated ecosystem. The hard data shows that having a stabilization sovereign wealth fund actually takes a ton of pressure off the central bank. Research indicates that countries utilizing a stabilization fund, like Chile's ESSF, require about 2.3 percentage points lower traditional foreign reserves to GDP than countries without one. Because the wealth fund is acting as a fiscal buffer, the central bank doesn't have to hoard as much cash to defend the economy. It's just an incredibly efficient use of national wealth. It's so efficient, in fact, that it caught the attention of the highest financial authorities in the world. After assessing Chile's central bank and its management of these funds, the International Monetary Funds concluded that Chile's transparent, accountable, and integrated approach is, quote, a useful model for other countries to adopt. We've seen how Chile turned a massive copper boom into a two-fund solution, protected it with strict central bank governance, and then leveraged private pension funds to create this natural shield against global financial shocks. So I'll leave you with this provocative thought. If your country struck an economic jackpot tomorrow, would it have the political discipline and the financial foresight to build an ecosystem this resilient? Thanks for joining me on this explainer, and keep asking the big questions.